Something shifted inside the financial system years ago, not in the way that makes headlines, not in the way that triggers news alerts or central bank press releases. It shifted in the architecture, in the structural decisions that wealthy families, private offices, and institutional capital managers make about how money moves. While most people were depositing paychecks, paying interest on mortgages, and watching their savings earn fractions of what banks earned on those same deposits, a parallel financial system was operating quietly in the background. Not a shadow system, not an illegal system, a private one, built on mechanisms that are legally recognized, structurally sound, and systematically used by every sophisticated capital manager who understands what the modern banking system actually is, and more importantly, what it is not. What the banking system is, a credit creation intermediary that collects capital from depositors at low cost, deploys it at significantly higher yield, and keeps the spread. Every time you deposit money, you extend the bank an unsecured loan at near zero interest. Every time you borrow, you pay the bank a rate built on capital that partially originated from your own deposits and the deposits of everyone else in the system. The bank sits in the middle. It earns on both sides. You see neither margin. What the banking system is not, a neutral infrastructure built to serve the financial interests of its depositors. It is a profit-maximizing intermediary. The difference between what it pays you and what it charges you is its revenue. Your financial passivity is the input. The spread is the output. That is not a critique. That is a description. And the people who built private financial architecture understood that description clearly enough to build something different. Let me tell you what that something looks like. There are three mechanisms, each one legal, each one documented, each one operating on the same underlying logic. Keep capital circulating inside a private system where you control the infrastructure, so the margin stays with you instead of with the intermediary. This is Capital Briefing. If you are here for the first time, subscribe now. What we build here is not personal finance content. It is financial intelligence, the kind that matters before events become obvious, before the crowd repositions, before the analysis is already priced into public awareness. If you want to understand how capital actually moves and where it is moving next, subscribe now and activate notifications. Let me start with the mechanism that is simultaneously the most powerful and the most persistently misunderstood. Mechanism number one. The private capital system inside permanent life insurance. I know what just happened in your mind. The phrase life insurance triggered an association, sales pitch, commission, something your uncle tried to sell you at Thanksgiving. That association is valid for most products sold under this category. It is not valid for the specific structural use I am about to describe. Here is what actually happens inside the structure. A permanent life insurance policy, not term insurance, permanent, built with premium loading, significantly above the minimum cost of the insurance coverage itself, accumulates capital inside the policy as what is called cash value. This capital grows under specific tax treatment, written into the Internal Revenue Code, Section 7702 in the United States, and equivalent provisions across most developed jurisdictions. The growth is tax-deferred at minimum, under specific structural conditions, holding the policy long enough, accessing it through loans rather than withdrawals. The capital can be accessed effectively tax-free during the owner's lifetime. But neither the growth nor the tax treatment is the mechanism that makes this structurally significant. The mechanism is the loan provision. The policy owner can borrow against the accumulated cash value, not withdraw, borrow. That distinction carries the entire weight of the strategy. When you borrow against cash value, the tax code does not classify the proceeds as income. You have not touched the underlying capital. You have borrowed against it. The policy asset remains intact. The cash value, the capital you borrowed against, continues compounding inside the policy as if the loan never happened. Read that again slowly. The money is still growing inside the policy, and you have the money in your hand, deployed externally. You are earning on both positions simultaneously, the internal compounding rate of the policy, and the return on whatever you deploy the borrowed capital into. The cost of that dual position is the policy loan interest rate, typically in the 3 to 5% range for well-structured whole life or indexed universal life policies. Put concrete numbers on it. $200,000 in accumulated cash value growing at 6% annually. A loan of $120,000 against that value at a 4% loan rate. That capital deployed into a cash-flowing real estate acquisition at 10% annual return. Simultaneous positions, 6% on $200,000 inside the policy, continuing to compound. 10% on $120,000 externally, 4% cost on the borrowed amount. The net structural outcome. The policy grows as if untouched. The external deployment returns 10%. The cost of that capital is 4%. The net carry on deployed capital is 6%, with zero capital gains realized, zero positions liquidated, zero tax events triggered. Now consider what a bank would have charged for that same $120,000. Market rate lending, credit assessment, the bank sitting in the middle of both your deposit and your loan, collecting the spread on each side. The private insurance structure eliminates that intermediary entirely. But here is what the financial industry does not want you to understand about this mechanism. It is systematically missold at the retail level. Insurance agents earn commissions indexed to death benefit, not cash value accumulation. The incentive is to sell maximum coverage, not maximum accumulation. A policy built for maximum death benefit allocates more of your premium to insurance cost and less to cash value. The product is optimized for the distributor's revenue, not your capital objective. The structure you want is the inverse. Minimum death benefit, only what is legally required to maintain the tax treatment, and maximum premium loading into cash value. This is specifically designed as an accumulation and capital access vehicle, not as a death benefit product. Before entering any such arrangement, examine the internal rate of return on cash value at years 3, 5, and 10. If the surrender value at year 3 is below 70% of total premiums paid, the cost structure is weighted toward distribution. The policy is not built for your objective. Walk away. Engage only with a fee-based fiduciary, someone whose compensation is not tied to which product you purchase. The conflict of interest in commission-based insurance sales is not incidental, it is structural. Used correctly, this mechanism is how private family offices manage capital across generations. Used incorrectly, which represents the majority of retail transactions in this category, it is an expensive lesson in incentive misalignment. Let me give you the broader context, because this is not just a personal finance mechanism. The aggregate cash value life insurance market represents approximately $20 trillion globally. Family offices, institutional investors, and private banks treat this as a standard component of capital architecture. The reason it remains largely unknown at the retail level is distributive rather than regulatory. The financial advisory ecosystem earns more revenue directing capital through institutional intermediaries than through private structures that keep the margin inside the client's ecosystem. That is the system. You are now aware of the mechanism. Subscribe to Capital Briefing if you want to keep going. What we are building here is a systematic understanding of how institutional capital operates, and how individuals can access the same structural logic. Each video extends that framework. If you are watching this thinking about the gap between what you were taught about money and what you are learning right now, you are in the right place. Subscribe and stay ahead of what is coming. Mechanism number 2, the retirement account loan, accessing your own capital without triggering the tax event. Here is the psychological conditioning that most people carry around retirement accounts. The money goes in, you do not touch it, and 40 years later it emerges as your retirement. That framework is structurally correct for the accumulation objective. It is incomplete because it treats the retirement account as a one-directional vault rather than as a capital asset that can be leveraged. There is a categorical structural difference between a retirement account withdrawal and a retirement account loan. A withdrawal before retirement age, the specific threshold varies by jurisdiction, but 59.5 in the United States triggers ordinary income tax on the full amount, plus an early withdrawal penalty. In the US, that penalty is 10%. Combined with income tax at typical marginal rates, an early withdrawal can cost 30 to 40% of the withdrawn capital immediately. That is not a capital access mechanism. That is a liquidation event with a significant embedded tax levy. A loan against the retirement balance is structurally different in every relevant dimension. Under most qualified plan structures, the account holder can borrow against the vested balance, up to $50,000 or 50% of the balance in the United States. The proceeds are not classified as a distribution. No income tax is triggered. No penalty applies. The capital moves into your liquidity position and returns to the account over the repayment period with interest. And this is the detail that most financial commentary buries. The interest you pay on this loan goes back into your retirement account, not to a bank, not to a lender, into your own future. Your present self is paying your future self. The same capital performs two functions simultaneously. It remains an asset within the retirement plan and provides you with current liquidity. Let me put this in the context of the wider capital extraction argument I opened with. Most people, when they need liquidity, reach for external credit. They pay the intermediary. The interest flows to the bank. The capital never comes back. The retirement loan mechanism redirects that interest flow. Instead of paying a bank 18 or 20 or 22% on a credit card balance, you borrow from yourself at 4 or 5%, repaid to yourself, with the capital continuing to grow inside the plan structure. The effective spread between eliminating high-rate external debt and paying yourself at the plan rate can be 15 to 17 percentage points on the capital deployed. There is no unsecured credit product in the market with that structural efficiency. For self-employed individuals, the structural opportunity expands considerably. The solo 401k, designed for self-employed individuals without full-time employees in the United States, permits contribution limits significantly above standard employer-sponsored plans. Current limits allow over $60,000 in annual contributions. The loan provisions are identical to employer plans. This means a self-employed individual can build a retirement capital base at an accelerated rate and access that capital through the loan mechanism for business or investment purposes without triggering distribution taxation. If you operate a business and do not have this structure in place, you are paying external lenders for capital that you could be providing to yourself at a fraction of the cost. I have to state the structural constraint directly because the mechanism has a specific failure mode. This is a short to medium-term capital tool. The repayment window is real and binding. In the United States, if you leave employment before repaying a plan loan, the outstanding balance typically becomes due within a compressed time frame, sometimes 60 to 90 days. Failure to repay results in the balance being reclassified as a distribution, triggering the tax event you avoided on the original loan. Know your plan's specific terms. The structural advantage is real. The structural risk is equally real. This mechanism works when deployed with discipline and clear repayment visibility. It destroys value when deployed carelessly. For the right capital need, eliminating high-rate debt, bridge financing, business capital deployment, this is one of the most cost-efficient access mechanisms available to any individual investor. The bank is never in the transaction. Mechanism number 3, the intra-entity lending system, private credit infrastructure within business structures. This is where the gap between people who understand capital and people who manage it by instinct becomes most visible over time. If you own a business entity, a corporation, a limited liability company, a holding structure, any closely held legal entity, you have the structural capacity to operate a private credit relationship between entities you control. Your holding company can lend to your operating company. Your capital management entity can provide credit to your active investment vehicle. Your asset protection structure can finance your operational activities. I want to explain this at the structural level before I get to mechanics, because the full significance of this mechanism is not visible in the transaction details. The modern banking system is a credit creation system. When a bank issues a loan, it does not transfer pre-existing deposits to the borrower. Under the fractional reserve framework, and in the post-quantitative easing environment, Under the excess reserve system, banks create credit at a fraction of the cost they charge to borrow it. They charge market rates for credit that cost them the overnight rate plus operational expense to originate. The intra-entity lending structure replicates the credit creation logic at the private level. You create credit within your own structure. You set a market rate of interest. The interest income flows to your capital management entity instead of to a bank. You control both the lender and the borrower. The spread stays inside your ecosystem. Let me make this concrete. Your capital management holding company holds $400,000 in investment assets. Your operating company requires $150,000 for expansion capital. You structure a formal loan between the two entities at the current applicable federal rate, or jurisdiction equivalent, let us say 6% annually. $9,000 in annual interest income flows to your holding company. The operating company deducts the interest as a business expense, reducing its taxable income. Your holding company earns that $9,000 as income. You control both entities. The capital remains within your consolidated ecosystem. The bank earns nothing on the transaction, but I want to spend time on the second function of this structure, because it is the one that institutional capital managers treat as primary, not the interest arbitrage, but the asset protection architecture. Consider what happens when your capital management entity holds equity in your operating entity, when it owns shares. Those shares are an asset of the capital management entity, but they are exposed to the claims of anyone who has a legitimate action against the operating entity, a business dispute, a contract claim, an operational liability. The equity position is vulnerable to legal claims against the operating business. Now consider what happens when your capital management entity instead holds a secured promissory note against your operating entity, not equity. Debt. It has lent money to the operating company and holds a legal claim as a secured creditor. In the event of insolvency or legal action against the operating entity, secured creditors rank ahead of equity holders in the distribution hierarchy. Your capital management entity, as a secured creditor, has a legally privileged position relative to unsecured claimants against the operating business. You have separated capital from operational risk through the legal classification of the transaction. Equity is exposed to the operating entity's risk environment. Debt, a secured loan, is insulated from it in a materially different way. This is not creative legal structuring. This is fundamental corporate and commercial law that has been applied by institutional capital managers and wealthy families for as long as limited liability entities have existed. Now, I have to address what the regulatory and tax environment says about this structure, because it receives specific scrutiny, and that scrutiny is legitimate. Tax authorities in every major jurisdiction, the IRS in the United States, HMRC in the United Kingdom, equivalent bodies everywhere, examine transactions between related parties under common control carefully. They are looking for arrangements that lack genuine economic substance, transactions created to generate paper deductions without real economic activity underneath. The requirements for this structure to survive that scrutiny are not complicated, but they are absolute. A formal, written loan agreement, not an internal communication, not an assumed arrangement, a signed document with the loan amount, interest rate, repayment schedule, and collateral terms stated with specificity, an interest rate at or above the applicable arm's length standard, the rate an unrelated third party would charge in a comparable transaction. In the United States, the IRS publishes the applicable federal rate monthly. Using a rate below this standard allows the tax authority to recharacterize the arrangement as a constructive distribution, stripping the deduction and adding tax liability. Actual repayment behavior, real transfers, real records, real payments on schedule. A loan that generates no payments and shows no movement over multiple years is, in substance, not a loan. The tax authority will treat it as what it actually is. This structure requires legal counsel familiar with related party transactions and a tax advisor who understands the substance requirements in your specific jurisdiction. It is not a do-it-yourself architecture. When constructed correctly, what you have built is a private credit system in which you are simultaneously the lender and the ultimate beneficiary of the borrower's success. Interest income builds wealth inside your capital structure. The borrowing entity accesses growth capital at market cost. Operational risk is separated from capital risk through the legal architecture of the transaction. Not $1 of unnecessary interest leaves your ecosystem to enrich an intermediary. This is the architecture that wealthy families have built quietly for generations, while the majority of financial commentary focused on which stock to buy next. Let me now bring in two additional instruments that I include here because intelligent people consistently overlook them, not because they are complex, but because they are simply not discussed in mainstream financial media. The first is the home equity secured line of credit used as investment capital. If you own real estate with meaningful equity, a mortgage substantially paid down, or a property with appreciation above the outstanding balance, you hold a capital access facility that most people treat exclusively as emergency backup. That framing is a structural waste. A secured line of credit against real estate equity provides access to capital at rates considerably below unsecured credit alternatives. The collateral quality, real property, lowers the lender's risk exposure, and that lower risk is reflected in the pricing. In most market environments, the rate on a secured home equity facility sits materially below what any unsecured product costs. The structural consideration that receives almost no attention. When that capital is deployed for investment purposes rather than personal consumption, the interest may be deductible against investment income rather than subject to the limitations that apply to personal mortgage interest. The effective cost of that capital is reduced by the tax treatment. The risk is direct and requires clear acknowledgement. The property is the collateral. If the investment funded by that capital fails, the obligation to the lender against your property survives the investment failure. This mechanism is appropriate for calibrated deployment with clear return visibility, not for speculative capital. The second is the securities-backed line of credit. For anyone holding a portfolio of publicly traded securities, equities, fixed income, exchange-traded funds, at a major brokerage, a secured borrowing facility against that portfolio almost certainly exists. Most people do not know it is available. Most of those who know it is available do not use it. The mechanism, your securities serve as collateral. The brokerage extends a credit facility, typically 50 to 70% of portfolio value. The rate is anchored to secured overnight financing benchmarks, structurally lower than unsecured credit because the collateral is liquid and easily marked. The structural insight. The portfolio continues compounding while you borrow against it. You do not liquidate positions. You do not trigger capital gains. You do not interrupt your long-term investment thesis. You use the portfolio's value as the basis for capital access, deploy that capital, repay the facility, and your underlying positions remain intact. This is how large investors and family offices make cash offers on acquisitions without liquidating portfolios. It is how capital remains deployed in high-return positions while simultaneously providing liquidity for new opportunities. The bank is never in the transaction in the way it would be for a conventional loan. The risk is specific and must be stated clearly. If the portfolio value declines significantly in a volatile market, the brokerage may issue a margin call, a demand for immediate repayment of a portion of the outstanding balance. Failure to meet that demand results in forced liquidation of positions at whatever price the market offers. In a severe market dislocation, this can produce a compounding sequence of losses. This instrument is appropriate for tactical, well-collateralized capital deployment, not for extended leverage against the full available credit line. Know your margin of safety before drawing on the facility. Now let me close the frame that I opened at the start of this video. Something shifted inside the financial system, not in the headlines, in the architecture. The shift was not sudden. It did not announce itself. But it has been accelerating, and it is now relevant in a way that it was not 5 years ago. Debt across developed economies sits at levels that have historically preceded structural adjustments. Central bank balance sheets expanded at rates that have no modern precedent. The dollar's role as the world's primary reserve asset is being actively questioned by a coalition of sovereign states, representing a significant share of global economic output. Geopolitical fragmentation is reshaping trade flows, capital flows, and the financial alliances that underpin the current system. In that environment, the private financial infrastructure I described today is not just a personal optimization strategy, it is a structural adaptation. The people who have built private capital systems, who keep capital circulating inside their own ecosystem rather than surrendering it to an intermediary layer that may itself be under structural stress, are positioned differently from those who have not. This is not about predicting a crisis, it is about building architecture that performs regardless of what the broader system does. Private credit infrastructure, properly constructed, does not depend on bank solvency. It does not depend on central bank policy. It does not depend on the continued functioning of any external institution. It depends on you, on the structure you build, on the discipline you apply to maintaining it. That is the architecture. That is the shift that has already started. The next wealth transfer is not waiting for a crisis to begin. It is already underway. In the capital allocation decisions being made right now by the people who understand the structure and those who do not. Subscribe to Capital Briefing if this delivered what you came here for. Activate notifications. The next video goes into the mechanics of central bank balance sheet dynamics and what the current trajectory implies for private capital positioning over the next 18 to 36 months. This is not market timing. It is structural positioning, understanding what the mechanisms predict before the headlines confirm them. Leave a comment. Tell me, what is the single largest interest cost you are currently paying to an external institution? And what would it change if you redirected that cost into your own capital infrastructure? The system is already shifting. The question is whether you are positioned on the right side of that shift before it becomes visible to everyone else.